In 2012, Iran lost access to its own money. Not in the sense of theft, not through inflation, through policy. With a stroke of a pen in Washington and quiet coordination across Brussels, Tehran's oil revenues, over $100 billion, became unusable, frozen in foreign banks. Technically there, but practically gone. And yet, Iranian oil kept flowing. Tankers still crossed the Strait of Hormuz. But the money for that oil could no longer return home. Instead, it sat in escrow accounts in countries like India, South Korea, and Japan, accumulating, visible, but untouchable. Iran had sold the world a vital commodity. In return, it received store credit. That's the paradox. It wasn't a blockade. It wasn't war. It was a financial airlock. Exports allowed, cash denied. The world needed Iran's oil, just not Iran's access to the proceeds. This mechanism was invisible to the public, but devastating on the ground. Imports vanished, factories shut down, the rial collapsed. And still, no bullets fired, no ships sunk. The sanctions worked like software, precise, silent, and total. Now here's the twist. By 2026, Russia is expected to double its annual trade with non-Western partners. But only a fraction of those transactions will be settled in usable cash. The ruble is increasingly regional. Western currencies are sanctioned, and dollar access nearly evaporated. Once again, a country is selling valuable resources. Once again, it can't freely use the money. What's different this time is not the method, but the target. Because the blueprint used against Iran is quietly being mirrored in Russia, with eerie precision. From secondary sanctions on banks, to escrow-style payment traps, to the weaponization of correspondent accounts. Some historians believe this was inevitable, that finance, not force, is the 21st century's real battlefield. And if that's true, then 2012 wasn't just about Iran. It was a test run. In January 2012, the European Union made a decision that sent shockwaves through the global energy markets. It banned all imports of Iranian oil. The announcement was coordinated with the United States, which had already enacted the National Defense Authorization Act weeks earlier, effectively threatening to cut off any financial institution that dealt with Iran's central bank from access to the U.S. financial system. Together, these measures struck at the heart of Tehran's economy. But behind the headlines, a deeper architecture was taking shape. This wasn't a simple embargo. It was an intricate network of restrictions, pressure points, and legal instruments designed not to block Iran outright, but to disconnect it. Why? Because by 2011, Iran was exporting 2.5 million barrels of oil per day. That volume couldn't just disappear from global supply chains without causing a price shock. The US and EU wanted compliance, not chaos. So the logic was clear. Let Iran sell. Just don't let it benefit. Here's how it unfolded. Iranian oil customers, notably India, China, South Korea, Turkey, and Japan, were quietly offered a deal. Keep buying oil, but pay into restricted accounts in local currencies. Those funds could only be used for buying a limited list of humanitarian goods or domestic products from the host country. No cash transfers, no foreign exchange, no repatriation. On paper, Iran earned billions. In practice, it had no access to global purchasing power. This strategy wasn't born in a vacuum. It emerged from over a decade of trial, error, and observation. From North Korea to Iraq, the West had learned that embargoes alone couldn't collapse regimes. What worked better was isolation through infrastructure. The target shifted from trade to transaction. By 2013, Iran was cut off from SWIFT, the Belgium-based cooperative that handles interbank messaging for 11,000 financial institutions worldwide. Without it, international transfers became nearly impossible. Even friendly countries faced logistical barriers in moving funds. It's hard to overstate the impact. Iran could still sell oil to China, but couldn't receive yuan in a usable form. It could still negotiate with India, but the rupees piled up in Indian banks, trapped by compliance frameworks. Imagine owning a business where customers continue to buy your product, but none of the payments reach your account. Now layer in the pressure. Inflation surged, the rial lost over 60% of its value, GDP contracted by nearly 9% in 2012 alone, and unemployment spiked. And still, this was achieved without a single military strike. Behind closed doors, some Western officials called it a masterpiece of asymmetric economic warfare. Precise, reversible, low risk. But the true sophistication of the system lay in its leverage. The US dollar remained the central node of global finance. Nearly 90% of foreign exchange transactions involved it. And that meant any institution that touched dollars, even indirectly, was vulnerable to US law. Even European banks, Japanese conglomerates, and Indian refineries. Washington didn't need global consensus, it just needed global exposure. In this framework, sanctions weren't just penalties, they were a signal that access to the global economy was now conditional on alignment with US strategy. This was more than diplomacy, it was protocol enforcement. The result? By 2015, Iran entered negotiations under immense economic strain. The Joint Comprehensive Plan of Action, JCPOA, was signed in July, exchanging nuclear compliance for sanctions relief. Some argued the plan averted war. Others saw it as economic capitulation dressed in legal form. But one fact was clear. The architecture had worked. And like all effective systems, it was quietly documented, modeled, and filed away. What happens when that same architecture is now being retrofitted for a country 10 times the size, with nuclear capabilities, vast reserves, and a central role in global energy? If the rules of access have changed once, what stops them from changing again? By mid-2012, Iran's economy resembled a sealed vault. Oil tankers still departed from Karg Island, contracts were still signed, refiners in Asia still paid, but the flow of money, the real economy beneath the surface, no longer obeyed traditional rules. This was not a failure of trade, it was a failure of access. Inside the country, the consequences mounted quickly. Pharmacies couldn't import basic cancer drugs. Industrial plants halted due to missing European components. Inflation soared past 40%. The rial crashed in slow motion, shedding half its value in a matter of months. But here's the paradox. Iran wasn't broke. It had money, just not where it could use it. At one point, an estimated $100 billion in oil revenue was immobilized, parked in foreign accounts across Asia. Not stolen, not lost, simply frozen in place by legal and institutional design. This wasn't a glitch, it was the point. Sanctions had shifted from punishment to containment, not about destroying capacity, but about disabling utility. And Tehran's central planners faced a unique problem: how to fund a modern state with access only to its own trapped capital. So they innovated, or rather, they adapted. Barter deals emerged. Iran bought Chinese telecom gear with oil revenue trapped in Chinese banks. It imported Indian rice and pharmaceuticals using rupees it could never convert. Oil for goods replaced oil for dollars. But barter, by design, is inefficient. You can't scale a 21st century economy on 16th century logistics. In one telling episode, Iran tried to settle part of its oil payments from Turkey in gold. By 2013, over $13 billion in physical gold had moved through Turkish intermediaries, flown, quite literally, on private jets to Tehran, in bars and coins. Out of necessity, not symbolism. This was not just workaround, it was systemic regression. A G20 economy reduced to smuggling bullion to bypass a banking firewall. But the most alarming development wasn't visible in trade statistics. It was deeper, institutional. Iran's economic logic was being rewritten. The central bank began issuing oil-backed debt inside Iran, denominated in rials, backed by revenue it couldn't touch abroad. This made the domestic money supply entirely dependent on frozen foreign assets, like printing IOUs on top of IOUs. Debt became an invisible battery, charged with money Iran couldn't spend, but had to pretend it still owned. And now comes the turning point, because by late 2014, oil prices crashed, from over $100 a barrel to under $50. Suddenly, not only was Iran blocked from using its oil money, it was also earning less of it. The same frozen account now held fewer digits. The illusion of deferred value collapsed in tandem with the global market. The system hadn't just broken, it had inverted. Iran was now exporting wealth and importing scarcity, producing value it couldn't realize, like a laborer paid in store credit at a store that never opens. What does that mean? It means Iran experienced a unique kind of economic paralysis. Not collapse, but disconnection. Not poverty, but isolation from the mechanisms that translate wealth into power. In a sense, it became a ghost economy, present in global supply chains, absent in global finance. And this matters, because this ghost structure, built in those years, 2012 to 2015, left behind a blueprint, a method, a formula. And though it was designed for a sanctioned theocracy, it's now being tested against a different target, with more money, more allies, and far more leverage. When the rules of connection are weaponized, trade becomes theater, and finance becomes terrain. Sanctions are often imagined as switches, on or off, allowed or banned, but the reality, especially from 2012 onward, is more like a circuit board, interconnected relays, controls, and fail-safes. The goal is not to break the machine, it's to reroute power away from the target. Let's trace how this system operated in Iran's case. Step 1. Target the transaction layer. At the center of global payments is SWIFT, a messaging network, not a payment processor. But without it, banks can't communicate securely across borders. In March 2012, Iranian banks, including its central bank, were ejected. This was the first time a whole country was cut from SWIFT. It wasn't just symbolic, it created silence. Step 2. Redirect the flow, not stop it. Rather than ban oil purchases outright, the U.S. introduced Section 1245 of the National Defense Authorization Act. The clause exempted countries from penalties if they significantly reduced their oil imports from Iran, a vague but powerful incentive. Major buyers like India and South Korea agreed. Imports declined, but didn't vanish. The twist? These countries were allowed to keep importing, but the money stayed in local escrow accounts. Let's pause here. If Iran sold $5 billion in oil to India, that $5 billion didn't go to Tehran. It sat in rupees in Indian banks. Iran could only use it to import Indian goods, not dollars, not gold, not even yuan. Each of these accounts functioned like a sandbox, isolating cash in a walled environment. Multiply that across 5 or 6 major economies, and you get a fragmented, non-convertible balance sheet, a kind of economic digital prison. Step 3. Limit what can be bought. Even within those escrow accounts, spending was constrained. Humanitarian goods were allowed: food, medicine, some industrial supplies. Anything with potential dual-use applications was blocked. No aviation tech, no advanced semiconductors, no European machinery, and no re-exporting. The money had to loop back to the country that held it. This created a closed circuit of value. Iran sold oil and could only buy back selected goods from the same buyer. Imagine being paid in coupons that only work in one store and only for socks and aspirin. Step 4. Pressure third parties. The key innovation was secondary sanctions. A Turkish bank that helped Iran transfer funds could be penalized, even if it didn't operate in the U.S. This globalized American jurisdiction. Risk managers took note. International banks began self-censoring. Transactions that were legal in theory became impossible in practice. By 2013, dozens of foreign firms exited Iran, not due to ideology, due to banking risk. Step 5. Create compliance cost. Each transaction with Iran now required legal reviews, multi-layered vetting, currency conversions, licensing, and paperwork. Trade slowed not because it was banned, but because it became operationally unviable. It's not that the door was locked, it's that the hallway was mined. And yet, the genius of the system was its reversibility. Every sanction had a built-in off switch. The logic was not to destroy Iran's economy, it was to compress it and offer release in exchange for negotiation. The system acted like a tourniquet. Tighten until the flow stops. Loosen if the behavior changes. This approach blurred the line between war and diplomacy. It used economic pain as pressure, but left infrastructure intact. And that's why it worked. Because when the JCPOA was signed in 2015, the networks could be reopened. SWIFT reconnected. Assets unfroze. Trade resumed. The machine was built not to crush, but to pause. And today, that machine hasn't been dismantled. It's been updated. Russia, by 2024, faces restrictions on over 1,800 entities. Over $300 billion in central bank reserves have been immobilized. Major Russian banks are cut from SWIFT. Transactions are rerouted through regional currencies, barter, and local accounts. But it's not a copy of the Iranian model. It's a sequel with more features. When finance becomes programmable, sanctions become a form of algorithmic control. And when trade is conditional on code, sovereignty becomes technical. If that shifted your view of how power moves today, share where you're watching from. By 2015, the map of Iran's economy had changed, not in borders, but in pathways. Supply chains were reconfigured, trade routes rerouted, financial trust recalibrated. The results were visible in data, but clearer in dysfunction. Factories that once relied on German parts now sourced from second-tier Chinese suppliers. Banking systems once connected to Paris or Tokyo operated on patchwork links to small, underinsured intermediaries. Insurance premiums for oil tankers tripled. Every transaction took longer, cost more, and moved less. This was not destruction, it was erosion. Sanctions didn't level Iran's economy overnight. They hollowed it out, quietly, like termites in load-bearing walls. Between 2012 and 2014, Iranian GDP shrank by nearly 9%. Inflation surged past 40%. Youth unemployment climbed above 25%. Critical medicines disappeared from shelves. Not by intent, perhaps, but as collateral. Imports of aircraft parts, laboratory reagents, and high-end manufacturing tools fell by over 60%. The automotive sector, Iran's second-largest industry, lost half its output in 2 years. This wasn't just hardship, it was demodernization. Each missing component meant a broken machine. Each blocked transfer meant a canceled contract. And each failed bank transaction carried a second cost, reputational decay. Iranian firms began prepaying for shipments they weren't sure would arrive. Trust broke down. Cash cycles stalled. For a brief moment, barter became the economy's nervous system. Gold flew to Turkey, tea flowed from India. Chinese construction firms accepted oil-backed credits, but none of it was efficient. Every deal had friction. Every workaround carried risk. And when oil prices collapsed in 2014, even that fragile system cracked. Iran was trapped in an invisible feedback loop, selling oil into accounts it couldn't touch, using credits it couldn't convert, to buy goods it didn't choose. And for the state, the political consequence was structural. Sanctions had turned the central bank into a triage unit. Revenue planning became guesswork. Budget gaps widened. Currency markets overheated. Every dollar that entered the system, legally or not, carried amplified political weight. Some officials tried to adapt. Others exploited the chaos. Smuggling networks thrived. Military-linked enterprises gained leverage. The private sector, fragmented, foreign-dependent, and already under pressure, lost ground to shadow finance. Sanctions were intended to punish policy, but they rewired power. By creating artificial scarcity, they inflated the value of access. And in doing so, they reshaped who controlled Iran's economy. Not by design, but as a byproduct. This is the long shadow of financial warfare. It doesn't end with policy shifts. It lingers in systems, institutions, and incentives. Even after the JCPOA lifted many restrictions, the scars remained. Banks hesitated. Western firms stalled. Iranian businessmen found that lifting sanctions did not restore trust. It simply reopened negotiations. And today, that logic is visible again. Russia's economy, by 2025, will remain the world's 11th largest by nominal GDP. It will sell oil, gas, fertilizers, and grain. It will trade with India, China, Turkey, and the Gulf. But much of that trade, like Iran's a decade earlier, will circulate in constrained loops: escrow accounts, non-convertible currencies, discounted oil in exchange for goods, a robust volume with restricted velocity. Russia is not collapsing. It is recalibrating, on the same logic that Iran was forced to follow. Except this time, the scale is larger, the stakes higher, and the system already battle-tested. Economic pain is measurable, but systemic distortion is harder to see. It lives not in inflation charts, but in how decisions are made under constraint. When a major power sells in hard value and buys in limited choice, its sovereignty becomes conditional, not to governments, but to gateways. The price of disconnection isn't silence, it's substitution. Then it was sanctions. Today, it's restrictions. Then it was SWIFT. Now it's correspondent banks. Then it was escrow accounts in India. Now it's frozen reserves in Belgium, yuan pools in China, and dirham loops in the UAE. The words have changed, the logic hasn't. Since February 2022, Russia has become the subject of the most comprehensive financial restrictions ever placed on a G20 economy. Over $300 billion in Russian central bank reserves immobilized. 7 major Russian banks removed from SWIFT. Tens of thousands of transactions rerouted, stalled, or canceled. And yet, the paradox mirrors Iran's. Russia is still selling commodities, energy, fertilizer, grain. Revenue is flowing, but access to it isn't. Let's follow the pattern. Russian oil exports haven't stopped. In fact, in 2023, Russia remained the world's second largest oil exporter. But the revenue, increasingly, comes in yuan, rupees, and dirhams, not dollars or euros. It's familiar. In 2013, Iran was receiving billions of rupees it couldn't convert. By 2024, Russia has accumulated over $40 billion in rupees stuck in Indian banks, unusable for global trade, only spendable on Indian goods. Iran had to accept rice, steel, pharmaceuticals. Russia is now importing tea, cars, and Indian mobile phones, not by preference, but by structural necessity. And like Iran, Russia has turned to shadow logistics. Reflagged tankers, undisclosed buyers, and mirrored trades through third countries. The dark fleet that once carried sanctioned Iranian oil is now populated with Russian barrels. Then, Turkey was a node in Iran's gold for oil workaround. Now it's a bridge in Russia's semi-legal finance web. And just as Iran resorted to gold shipments to bypass blocked accounts, Russia's central bank has increased its gold holdings and is exploring cross-border settlements in gold, not for tradition, but to escape dollar-based rails. But here's the deeper parallel. Both states adapted and hardened. Iran's economy became a hybrid system, sanctioned externally, subsidized internally, and brokered through informal networks. Russia is heading in the same direction. Moscow is pushing trade through the System for Transfer of Financial Messages, SPFS, its SWIFT alternative, and expanding usage of MIR, its domestic payment card. But none of these tools are global. They're substitutes, not replacements. That's the cost of forced autonomy, duplication without reach. Iran once had 70% of its trade processed through European banks. After 2012, it dropped to single digits. Russia, in less than 2 years, has seen a similar decoupling, not by loss of production, but by isolation from the pricing, clearing, and financing systems that define value. And like Iran, Russia has had to make internal trade-offs. To keep stability, the Kremlin has expanded state spending, imposed capital controls, and pressured exporters to convert foreign earnings. The result is surface stability and deep structural distortion. This is the true mirror. Sanctions are not just about punishment. They are economic climate change. They force entire systems to mutate. They distort prices, redirect trade, empower parallel actors, and reshape incentives. In Iran's case, military-aligned firms gained control over key sectors. In Russia, the FSB, state-owned corporations, and systemic oligarchs are absorbing more and more market share, not through competition, but by survival in a constrained system. Both cases show the same formula. When access is blocked, power consolidates. When money is trapped, the gatekeepers gain leverage. And here's the final symmetry. In both cases, the target adapted, but the world moved on. When sanctions were lifted from Iran in 2015, much of the West had already replaced it with alternate suppliers. And when, or if, Russia regains access, it may find that the financial networks it once relied on have evolved without it. History didn't repeat, it recalculated. The Iranian Sanctions Playbook wasn't retired, it was copied, streamlined, scaled, and redeployed, not as an exception, but as a framework. We used to think of sanctions as a tool. They've become infrastructure, not a reaction, but a standing system, with protocols, dependencies, backdoors, quiet agreements between central banks, risk officers, and compliance teams from Seoul to Zurich. What began as an improvised workaround in 2012, local currency escrows, tiered access, financial decoupling without outright embargo, is now quietly shaping the reality of a major global power. And yet, the questions remain. What does it mean to have reserves you can't reach, to sell value and import limits, to operate inside a mirror economy, visible but distorted? Some argue sanctions are a bloodless alternative to war. Others say they're just slower. But the more striking truth may be this. Sanctions don't stop systems. They change their shape. Iran's 2012 blueprint was about freezing without starving, trading without trusting, negotiating without conceding. Today, that same logic encircles Russia's 2026 economy, and the playbook, once experimental, has become policy-grade software. Not every script needs rewriting. Some are simply recompiled.